JBlog, November 1st, 2009. Last week saw a lot of activity, and I have been talking about this activity before. Um, Previously, whenever this kind of drop occurred, it picked right up again and went back to new highs. This time around might be different, might not be different. I think it's different. It looks quite different. It could be a rerun of June, where we're looking at maybe a month of downtime, month and a half of downtime, and then pick back up. Or we could be looking at something more dramatic, and I believe that there's a possibility of something more dramatic happening that most people simply do not expect, just because there's this idea that um, the economic crisis is over and we are in a recovery. And from what I can tell, that the idea where that recovery comes from is basically that the stock market is known to be a leading indicator. The stock market went up, therefore there must be a recovery. Yet I'm looking at this chart here. I'm looking at 9-month chart, and the story is that the stock market leads the economy by 6 to 9 months, and when there's uh, a recovery in the stock market 6 to 9 months later, there will be a recovery in the economy. We are now 8 months later. So this was the low point right here. This is where the stock market picked up. And we are now roughly 8 months into this stock market recovery. And I'm looking out the door and I'm going, there's no recovery out there. There are more people laid off. Property prices are still falling, contrary to what the indexes might tell you. Real property prices are dropping. The increase that you're seeing in property prices is simply statistical from them increasing from really, really bad, but that's not increasing as in home prices actually going up. That's simply sales happening at a higher price because the first panic is over. That doesn't mean home prices are actually going up. So one of the indicators that I do like to look at, just because it produces very few false signals, is the exponential moving average 1030 crossovers. Here I have marked the exponential 10-day moving average in red and the 30-day moving average in green. And these averages, unlike the MACD and other ones, these averages do not cross very often. They did cross here once, but then went back up again. And so for the last 8 months, 7 months or so, these indicators have indicated a bullish market going up. They have not crossed over. Now, one thing that has happened, or I should say that is about to happen, is a possible crossover here. We'll have to see, maybe Monday, Tuesday. If we have another bad day on Monday or on Tuesday, definitely they will cross. And then what we would need after that is we would need them to, the red to cross over the green, try to go up above again, and then fall down again and go further. That would be an indication that the bull run is over and a new bear market has started. We'll see whether that happens. It has already happened in several other markets. Here is the transportation average. Now, original Dow's theory stated that industrials and transportations have to confirm each other. It makes sense that goods are made and goods are shipped. Now, if the industrial average goes up but the transports do not go up, then that basically means goods are being made but goods are not being shipped. That is not sustainable, obviously. So we're looking at the transportation index, which is much, much weaker than the Dow Jones Industrial Index. The Dow Jones Industrial Index is still showing very bullish, having had a bad day, but definitely still higher highs and higher lows. While the transportation average, on the other hand, has actually made, this is almost a double top, a slightly higher top, But on the other side, we are seeing a lower low. Definitely. We're seeing similar things in the smaller exchanges. Here's the New York Stock Composite, and there we still have made a higher low for the time being, although that low is not quite in place yet. And the OBVs definitely are not confirming the higher high, and I've mentioned that before. RSIs are not confirming higher highs neither. But going back to the Russell, this, by the way, is the VIX. The VIX suddenly shoots up to above 30, shows that there is fear back in the market. The one I'm looking for right now is the Russell. Where are you, Mr. Russell? Somewhere down here. The Nasdaq, smaller companies generally, has almost made a lower high. And then looking at the Russell 2000, which of course consists of 2,000 small companies, and it has made a lower high as well. The mid-cap 400 has also made a lower low. Sorry, lower, not lower high, lower low. Has made a lower low. So the smaller stocks are definitely showing a lot more panic than the big ones. Again, this is another thing that Joe Granville talked about in his new strategy of daily stock market timing for maximum profit. Very, very good book, interesting book. He's talking about that small stocks will always collapse before the big ones do, simply because the small stocks fundamentals are not as good, and they're simply smaller ships, so they turn faster compared to the big freighters, the big aircraft carriers like the Apples and the Johnson and Johnsons and the IBMs and so on. They just do not turn on a dime like the small ones do. Another interesting chart to look at on stock charts is the bullish percentage index, which looks at how many charts are deemed to be bullish versus how many charts deemed to be bearish. And this once again shows that the recent higher high in the stock market has not been confirmed with the number of stocks charts that are actually looking bullish, and has actually made a lower high here. So once again, it's another technical non-confirmation of the price. So what does it all mean? Depends again on how much liquidity will be pumped into this market to keep it up. I continue to believe that this is a fake rally. This rally was brought about by too much liquidity. It is not founded in actual fundamental actual fundamental basis, and therefore it can collapse anytime. I was reading a very interesting article a little while ago that talked about how the technicals and the fundamentals interact, and sometimes the technical traders get ahead of themselves, and there's nothing fundamental underneath to justify the technical position. And if that technical trend ever ends and it falls, there are no fundamental traders, fundamental investors to catch it, simply because everyone says this is too expensive and I ain't buying at this price. So we could see something rather furious here, quick decline down to a point where the market once again makes sense, or we could just keep going, because at the end of the day, if liquidity continues to find its way into this market, the easy money, the fast money finds its way into this market can just keep going for no fundamental reason whatsoever. Unfortunately, eventually it has to give up, and then the crash will be even bigger than it is now. I prefer to have it now rather than later. That's all I have for today. Myself trades mostly short. I'm long the US dollar. Else than that, I am very strong on the short side of things. I'm happy on the short side of things, as I've been for a while. And we'll see how it all goes. I hope you make lots of money. Good luck next week, and all the best to you. Bye.